All right, welcome back, everybody, to another Study Wealth podcast episode. With me today, Eric McArdle from Now with Liquid Strategies. He's a friend of the show. Wanted to catch up, particularly in these turbulent times here. We're seeing equity market drawdowns, lots of headlines. So I thought, who better to catch up with than Eric as far as volatility and options are concerned? Eric, how are you?
Serge, doing great. Great to see you. Wish it was under better circumstances, but always good to catch up.
Now, the market, gives you what it gives you. There's not much choice we have. I think the point is, to make the best of it, and that's kind of exactly what we want to talk about. When I talk to our clients, a lot of people they think they are not very risk averse, meaning they're willing to take risk until the market actually goes down. Let's talk a little bit about that, right? Because a lot of people don't really want to get too granular and have 1,000 different options positions on. But what is sort of your overall view of sort of how to do this in a portfolio context? And I should say, and maybe you want to, I don't know if you can introduce quickly Liquid Strategies, where you guys really specialize in this, right? I should probably preface with that.
Sure. So again, thanks for having me at Liquid Strategies and Overlay Shares ETFs. We really specialize in building intelligent options-based strategies. So things that can allow you to
Yeah.
benefit from harvesting options intelligently or buying options to use them as a hedge under, scenarios like the one we're living through this week. But
Mhm.
I think, back to your question, behavioral finance and behavioral science really emphasizes the fact that most of the time people are pretty comfortable because most of the time bad things aren't happening. But when bad things happen, whether it's my wife telling me I need to hit the gym or my stock portfolio falling 10% in 2 weeks or a week, those moments sting much, much worse, right? And then when they sting, if we're not prepared for them, we tend to make poor decisions, right? Like selling out of the market altogether, or like doubling down, or insert bad choice here. But the point being is that when you have that weakness as a human being, and we all do, right? Because we are human, you want to try and pre-plan for that, right? And I think there's a couple of different ways to do that in the market. And that's what we try and help at least with some aspects on over here at Liquid.
Sure. When we look at this, right? So we're looking at, as we're recording this here, we're looking at the S&P having so far a drawdown of about 16, 17, whatever percent it's been, or something like that. Uh, at least peak to trough so far. And as head of Advisor Solutions, obviously you're talking to advisors as well. What do you think is kind of like is there a pain threshold that you feel kind of like is there sort of where they start sitting up and taking notice? Because it's different for everybody, right? So I'm just kind of wondering what you're experiencing, because people listening here right now are, may be okay if the market drops 5%, 10%, 15, maybe 20. And then of course the question is, how long does it stay down? That might be the bigger question. But I don't know if you see some sort of uniform pain threshold.
Yeah, I'd say typically if the market's down about 10%, the phones start to light up a little bit,
Yeah.
right? Or the email box lights up. And it really depends on the client and then, that
Yeah.
client's clients and how they've
Yeah.
kind of trained folks. But I would say that, it's kind of like when you're going high beta in the market or high risk, if you do that for a long time, it's kind of like, eating ice cream all the time and, it feels really, really good, right? And then you have this crash where it doesn't feel as good.
Yeah.
And I feel like, for the allocators that we work with who are really, really risk on all the time, like it's felt great for a while, right? And then they have this kind of like, crashing moment where, oh, SHIT, I've got to really like think about how to get out of this.
Yeah.
Whereas, the folks we work with who are eating salads every day, right? Like to be a little bit more conservative, a little less flashy, a little less exciting, they generally tend to be pretty confident where they are, right? And I
Mhm.
think finding a balance of the two is really what most of the people we work with kind of try and strike.
Makes sense. I mean, we are coming out of this 12, 13, 14, arguably 15-year raging bull market, right? Where there wasn't much thinking needed. And so the muscle memory is there, right? And it's going to take a while to kind of think otherwise. But aside from just going out there and buying puts, which is some people they do that. It's quite a bit of work. I always try to explain to people, oh, I'm just going to go buy some puts. Sure, by all means, just and then they are typically pretty quickly overwhelmed, uh, by how much work that actually is. If we go into this a little bit, then I'll share a couple of charts here as well in a minute, so we can have this conversation visually as well.
Yeah, I think while you're pulling that up, there's a couple of different ways to do it, right? You can hedge your risk assets with things like bonds. You can use trend strategies or commodities, and then you can use volatility or directional strategies like
Mm-hmm.
option buying or put buying. And they all kind of do different things, and so you need to know what they do, what they don't do, and for each type of those diversifying strategies, they all have different ways of executing, right? And so um, go before we go into this graph, just thinking about like
Sure.
if going back to buying options, right? It's very much like buying insurance. And for those at home, and everybody has some type of insurance, you have comprehensive insurance that has a very low deductible but is very expensive, right? And then you have catastrophic insurance, which has a much higher deductible and is much more affordable.
Mm-hmm.
Certainly in the market, you could go buy comprehensive insurance all the time and be covered against anything, but it's so expensive, right? And you're gonna feel that. I think where we find in our strategies and also just across kind of the option trading world, where the most bang for the buck while also kind of preserving the upside of your other assets or the rest of your portfolio, it comes from having catastrophic insurance or insurance that doesn't necessarily materialize unless you get into a market like the one we're living through right now. And so, with this chart you pull up, right, where you've got, in the last, let's say 30 years, or 40 years rather, you've got multiple different bear market scenarios, right? And some of these were very fast, some of them are very slow. But ultimately, every bear market looks a little different. And so having something like put options in the mix can really help specifically with faster bear markets. Whereas other bear markets might have things like commodity trend or managed futures
Mm-hmm.
really help balance that out. And, thinking about what those things do. And then, and we might come to this here in a second, Serge, but I think it's really important for investors to have a process with their hedge, right? Because the hedge at some point you need to take it off and you need to do something with it, right? And so maybe we'll segue into that in a little bit.
No, of course. I mean, what you're saying here is it's not just a matter of buying a put and letting it sit for a year, right? Because I think
Mhm.
that's again, like I said before, it's one thing that people think is something to do, and it's one thing to do that if you own like a stock, let's say you own Apple, right, and you want to protect it and you just buy some puts, but doing that on like a whole portfolio or a basket of stocks can pretty quickly become a bit overwhelming, particularly also, you know, considering that usually when people allocate from a portfolio perspective in their money, it's like a larger chunk of their net worth than, let's say, in just a pure trading account. So I think some of that plays into this as well. But let's talk a little bit about the number of days to recover from a drawdown, because I think that's where a lot of people, we talked about risk tolerance before, and I would argue over a shorter period of time, be that a few weeks or a couple months, people are pretty risk tolerant. It's just the question is really how big is the drawdown, and sorry, how quickly does it rebound? I apologize. How quickly does it rebound? Because you think of COVID. I mean, yes, some people panicked, but I think we were all busy trying to buy masks, and by the time we were done buying masks, the market was back at all-time high. So it didn't really matter that much, right? People weren't that concerned because the market wasn't down very long. But when the market's down for a while, and for a lot of people, that's 6 months. That's typically a pain threshold that's kind of known. That's typically where the problem arises. So let's talk about the number of days to recover, and then we can talk about sort of the more intricacies of some of these strategies as well.
Sure. Yeah, and so as we can see here, right, that number of days to recover can really vary. And I think what's super important, if you're a younger investor, that recovery period is much less important than if you're an older investor and in the kind of the distribution phase of your portfolio life, right? Where you're
Yeah.
taking income, you're taking withdrawals, and you might be living on, your investment returns, right? And so if you are heavily allocated to risk, say all stocks, and you go through a period where the market sells off and has a catastrophic sell off and then takes a long time to recover, as you're eating into those returns, not only from the drawdown, but also from your distributions, right, which you're living on and generating income from, it makes it that much harder for you to ever recover. Right. So, while being kind of slow and steady and being a little bit more conservative as you invest, it feels, not as sexy or as exciting. It's very prudent because as you go through a drawdown event, you really just want to be able to stay as close to your originating value as possible and have some accrual over time, right? And
Yeah.
so there's a real simple kind of rule. If you think about if your portfolio loses 50%, do you need 50% to get back to break even? No, you need 100%, right? So, there's a lot of kind of basic math in this where it just says avoid drawdowns and then also be very mindful of where you are in that period of your life, whether it's accumulation or distribution.
Yeah. Oh, for sure. I think the quicker you can recover, the more, the lower your blood pressure over time. Because I think that's really, something where a lot of people really panic at the wrong time. And that's kind of the point, right? So, you know, speaking to the point of insurance, I mean, a lot of people have insurance on their home and their car or whatever. Some of it required, obviously, but on their portfolios, a lot of people just don't, right? And
Right.
some of it is the complexity, right? But then that's the good news nowadays. We can actually buy products like ETFs, for example. I know you guys have some great ones too, where that's actually being done. But if you want to, let's talk a little bit for just a moment. I don't want to get too complex here, so people's sort of eyes glaze over. But very simply put, uh, you know, there is a there's options buying and options selling taking place when you think about hedging a portfolio. Maybe let's talk a little bit about that.
Sure. So, like insurance, most of the time you pay for insurance, you don't use it, right? And so generally it is profitable to be a seller of insurance, which
Mm-hmm.
is why insurance companies are generally good businesses. But if an insurance company, let's say, is selling insurance to homeowners in Florida and doesn't factor in the risk of a hurricane coming through every year
Yeah.
or every 2 years, right? Then that insurance company is going to be out of business at some point. And I think that's
Mm-hmm.
very, you can take that same concept and apply it to selling options in the stock market.
Yeah.
And so if you're getting paid a lot, right, if you're collecting a lot of premium to sell options, generally you're being paid that for a reason, right? It feels like a free lunch because you win most of the time, but eventually Mr. Market's going to wake up and you're going to be reminded of why you were being compensated for that risk. And so as a buyer of options, the opposite is kind of true where you say, look, eventually I'm going to quote unquote win, but I also don't want to be buying insurance for 5, 6, 7 years and spending so much that eventually I don't have returns, come out of it, right? Like by the time I see that payoff, it's too little, too late. And so we think, and again, our peers who are in the option trading business, we think about finding ways to kind of intelligently marry either selling, some volatility or selling some downside or selling optionality, but also maybe buying a little bit of protection below it or above it if you're selling a call. That way, if you have one of those hurricane events, you won't die from it, right? Technical term, but it won't be catastrophic. And then on the other hand, if you're buying insurance or buying put options, for example, you would say, hey, how do I do this in a way where I'm not spending a ton of capital each year and I'm still getting a potential, positive payoff when this happens. And then most importantly, I think the biggest challenge here, Serge, for option buyers is knowing when to cash out, right?
Mm-hmm.
When to monetize their gains, when to take that gain that they've had from the option contract appreciating and sell out of it and then take that capital and do something else with it.
And how much of that is for what you guys do is a matter of analyzing the market, sort of, I'm going to call it market timing, and actually just understanding the options part of it, which, is two different things.
Yeah, that's a great question. So we know that selling options is generally a winning trade, right? And so well, let's call it 75% of the time, we're going to be very comfortable with that position and we're going to know that we're compensated for the remaining 25%.
Mm-hmm.
And so it kind of becomes um, I won't call it a free lunch because nothing is, but it's a free lunch where you go, but you don't stuff your face. You don't leave there having to be rolled out on a cart. You just take the risk. You're modest with it and you position yourself so you don't have the risk of not being able to fight another day. Right.
Mm-hmm.
And then, when the option buying side, and so I guess to answer your question more explicitly then, so that is more of a systematic trade, right? Where we're putting this on every couple weeks, right? And just having these kind of laddered and reducing our risk of being wrong by having multiple similar positions on over and over. Um, and sometimes when you're selling options, if you win big early, right? If you win, 80% of your trade in a couple of days, we may just pull the risk off. Because at that point, the reward to risk, which is always something investors should be thinking about, how much can I lose versus how much, or how much can I win versus how much can I lose? If that reward to risk becomes really out of whack, you don't want to be sitting on it, right?
Yeah.
And so that's very important versus, just a naive, totally systematic strategy where you sell over and over and over again without any kind of, active component in the market.
Yeah, yeah.
Um,
And then, I think another important point is when, like, I'm just looking at this graph here, and I'm assuming the zero cost put spread collar index is sort of a proxy to this kind of a strategy, which is the purple, the orange line on the screen. The recovery period, I think, is something we talk about as well, which we touched on it before, but not as much. The recovery period is much quicker when you have a drawdown than, let's say, the S&P 500 because of this option strategy.
it is, but and this is where you see a lot of kind of combo option strategies in the market, things that are called hedged equity or defined
Yep.
outcome, right? Where they're selling an upside call and they are then buying a downside put spread, meaning they're buying protection to give up, they're giving up their upside in doing so.
Yep.
And so we put this in here because we have kind of a different view on this where you own stocks because they go up, right? And so our view is if you own stocks, why would you want to cap that upside, right? And so over time, if you are running a hedge strategy where you'll notice the orange line has lower drawdowns than the stock market
Yep.
by design, but if held through a full market cycle by capping your upside over and over, those few years where the S&P is up 30, 35%, if you're only able to participate partially in that,
Mm.
like you've kind of diminished the value of owning stocks. So that's why this stuff is really challenging because you can kind of come across an idea and go, aha, I found the golden ticket. But if you're not considering what the asset class does or is designed or is typically done, you can find yourself in kind of a suboptimal position over time. And so for
Yep.
us, we just say, hey, rather than capping the upside, we're willing to spend a little bit each year intelligently on buying those laddered put options and leave the market exposure uncapped. And basically, it's like paying your homeowner's insurance, right? You pay it every year. It's something you don't really like to pay, but hey, if your house is still standing and appreciating in value, great.
Yeah. Yeah. So I think what we're trying to explain here is that you should always have insurance on a portfolio because it's not so much that, like, right now, right? People are getting more concerned about the stock market going down because it has been going down year to date. Um, it's not so much that the stock market is never going to go up again. It's the question is how long does it take to recover? Because a lot of people, the smaller the drawdown, the less likely it is that they panic at the absolute worst possible time.
Yep.
And I think that's why this is such an important concept. Now, obviously, one can try to do this themselves, but again, I think it's one thing doing that in your trading account on a stock that you own, but doing it on an entire portfolio, or even like on the S&P 500 is actually, particularly over time, it takes quite a bit of work. So I know you guys have. I know you can't mention the ticker, but I think I can. One ETF that does this is OVLH, ticker symbol OV, V like Virginia, L and an H. Would be able to do this kind of a hedged equity strategy. I know we've gone through a bunch of stuff here, and I'm mindful of the time. Is there anything else that you want to quickly unpack, or any final thoughts on this?
No, I think, this has been a constructive conversation, Serge, and a lot of times, unfortunately, these conversations happen after there's already, blood in the streets, right? And um, I would encourage anybody watching or listening, reach out to Serge. Happy to talk as well. And if you ever have questions about these concepts and just kind of want to explore them more deeply, that's what we're here for, right? We enjoy this. This is why we hop on and do this occasionally, and always happy to chat.
Yeah, no, it's great to have you. And again, you are with Liquid Strategies. What's the website? LS.
lsfunds.com.
That's what it is. LS Funds. I was looking for the last part. The lsfunds.com. You guys also have a great blog where you can read on some of this stuff, and so really good stuff. Well, it's great to catch up with you, Eric. I hope all goes well for you for the rest of the year. I know we're still in the early part of the year, but it's certainly a more interesting environment, I think, than we've had for quite a bit here. And so wish you all the best, and hopefully until next time. Hey there, I hope you found this video helpful. Now, please make sure you click up here to get much more of our great videos, our great insight into the markets, analysis, and excellent interviews with professional traders and investors.